In this video, I want to share with you the weird accounting reason why a royalty company can have lots and lots of cash flow but show very little net income. This is one big reason why the PE ratios on the royalty companies are often so high. This example that I'm going to show you here is from Sandstorm Gold's royalty, well, it's a stream actually, on the Greenstone mine that Equinox just finished building. So they bought this as a package of royalties, so there isn't an exact purchase price, but let's say the purchase price for this stream is $160 million. For that, they get, to start out, 2.375% of production. And this mine is set to produce at 400,000 ounces a year to start out. So 400,000 times this percentage is 9,500 ounces a year. So that is Sandstorm's attributable production for year one. As part of this streaming deal, for every ounce of gold that Sandstorm receives, they have to pay the operator 20% of the current spot price. So for this example, let's say that the average price of gold is $2,000 an ounce. They would pay $400 an ounce to the operator of the mine, guaranteeing them 80% margins, and they would be earning $1,600 per ounce of gold received. $1,600 times 9,500 ounces is $15.2 million. That is the cash flow that Sandstorm is going to receive in the first year of operation from those 9,500 attributable ounces. So you might think, okay, Sandstorm got $15,200,000, subtract a little bit of their overhead, and that's their net income, right? No, not even close. They have to depreciate this amount that they paid for the royalty. So how they typically depreciate it is they depreciate almost all of it over the initial mine life. So Greenstone, to start, has a 14-year mine life. They'll take the 14 years and then they'll probably add just a little bit to account for some of the resources that aren't part of the reserves. Maybe they depreciate it over 16 years. You have a $160 million purchase price divided by 16 years, meaning they're taking a $10 million depreciation expense every year for the first 16 years. So maybe after some expenses related to this, they end up having cash flow of $14,500,000. However, that's not what shows up on the income statement. On the income statement, they take this number, then they subtract the depreciation for a net income. Well, actually, this isn't the net income. Then they subtract other expenses like maybe stock option compensation and maybe some other expenses as well. But even when they had cash flow of $14,500,000, they may only show a net income of $5,200,000. Now, this is actually very good in terms of how much income tax they pay, because they pay income tax on this amount, but they can reinvest all their cash flow and do this all again. Now, it's reasonable to have to depreciate the amount you paid over the course of when you're going to receive that money. However, it's not like they're going to stop receiving money from this after 16 years. So let's say the Greenstone mine starts out with 5.6 million ounces of gold, and then year one, they mine 400,000 ounces. Year two, they mine 400,000 ounces. But in the meantime, they've been drilling and they've been trying to discover more ounces on their property, and they do some economical studies, and then they're able to convert some ounces into reserves. And then after 2 years, they've mined 800,000 ounces, but then they're like, hey, we were able to add 1 million ounces to our reserves, and now we actually have more reserves than when we started mining. And on these very, very prospective mines, this is often how it goes. A lot of times they can replace the ounces they're mining. Maybe they replace a little less, maybe they replace a little more. But the initial mine life was 14 years. However, for the average gold mine that goes into production, it ends up running for triple that, for triple the initial mine life. Chances are that it's going to end up operating and mining gold for 42 years if it were the average mine. However, tier 1 mines tend to deliver a lot of good surprises. So the tier 1 mines tend to go even longer than 3 times the initial mine life. And Sandstorm's land package around this mine is enormous. I think they have something like 40,000 hectares. So, like for example, here's the little deposit that they're mining for greenstone, that they're mining these 5,600,000 ounces of reserves. However, Sandstorm's land package compared to this little thing looks like this. It's enormous. So anything that they discover here, anywhere in here, Sandstorm is going to get a stream on that. So they continue replacing their attributable ounces even as the mine is depleting these reserves every single year. So just from an accounting perspective, after they've depreciated the entire purchase price after the 16 years, the mine starts to look a lot more profitable. But just from an accounting perspective, it's been cash flowing like crazy this whole time. So Equinox is operating this greenstone mine. And what we typically see these mines doing when they have long mine lives, when it's in a really great district and they have lots of exploration potential, they drill like crazy trying to expand their resources. And then when they expand their resources, then they're like, okay, let's move this production forward by increasing our mill capacity, by expanding our mill. So instead of being able to produce 400,000 ounces a year, we'll be able to produce, let's say, 600,000 ounces a year. And after 16 years, this is totally depreciated. So let's say that Equinox has expanded their mill. They've been drilling like crazy to find as many ounces as possible to keep the mine running as long as possible. And they've expanded their mill. And on year 17, Sandstorm receives 25 million in stream revenue from this. Well, they've already fully depreciated this. So in year 17, this is just the net income. So later on in the mine life, after the mine has been operating for a long time, from a net income perspective, just in terms of accounting, the stream starts to look a whole lot more profitable. But in the meantime, throughout these 16 years, Sandstorm will receive a lot of money from this stream and be able to reinvest it in other streams and other royalties where they get to do this all over again. So it's actually really good from a perspective of how much income tax they have to pay because it reduces their current net income by quite a bit. Anyway, I hope I explained this well enough. If you enjoyed this, please subscribe to the channel and next watch this playlist that's going to make you a better mining stock investor.